this first problem is relatively simple. It just kind of to get us warmed up. And then I have just kind of as heads up, I have an interesting Excel exercise. I know people kind of have preference for Excel or they like Excel. That's what I've been kind of gathering from this class. And I decided to give you, an interesting problem in Excel. So just maybe as heads up, the next problem will be in Excel. You will need a very small template from Canvas. So, these slides, you can find them on Canvas, and next to it, there's a very just basic Excel table that I will start with in the second exercise. So as I speak, you may want to download that. And just kind of, again, like as heads up, that problem, the second problem that I'll be doing is from MyLab Finance. So if you follow me along, it'll help you with after-class homework. So again, it's kind of incentive for you to get this Excel file pulled up and follow me along, because it basically you'll be required to do very similar thing for your homework. But let me kind of just warm us up and solve this quick problem here. It's just kind of introduction to free cash flow valuation. The local franchise of Jiffy Lube is thinking about buying a new lift for $60,000. Okay, let me make sure I can write here. 60,000, and that would make it easier to access the oil filter in customers' cars. The savings would increase over the three-year life with the projected growth of the business. So we are given Ebit here. So that's the kind of starting point for cash flows. The machine is to be linearly depreciated to zero and will have no resale value after 3 years. The appropriate cost of capital is 16% and the tax rate is 21%. What is the free cash flow in year one? So, well, they kind of laid it out for us. So we need to calculate taxes on Ebit. And for that, we'll simply multiply Ebit by taxes. So tax in year one would be negative 2,100. In year two, it'll be 13,000 multiplied by 21%, so it'll be negative 2,730. And then in the third year, it's negative 4,116. Are people getting these numbers?
Yes.
Good, appreciate it. Yeah, sometimes I like it to calculate, but it's kind of, I know when I was in the class a long time ago, I kind of didn't like that kind of questions, So I'll try to not to kind of ask too simple questions, but again, whenever you can chime in, please do so. Net income, so it'll be just the difference between Ebit and tax. So here it's 7,900. So next year it's 10,270, and then year after 15,484. Right, just the Ebit minus taxes. And then to get to cash flow basis, we need to add back depreciation, right? Depreciation is a non-tax item, or so non-cash item. The reason why we subtract it, you can see kind of laid out here. The reason why we subtract it is to calculate taxes, right? But otherwise, it doesn't really impact cash flows other than it reduces our taxes. So we'll add back 20,000. And our free cash flow would be 27,900. Here it's 30,270. And the last one is 35,484. Right? And then, so we've got these questions answered. And then the last one is, what's NPV? Very simple, you'll take free cash flows, positive sign, and then make initial investment -60, and then just calculate the present value of these four cash flows at 16% discount rate. Try that on your calculators. Tell me the answer. Like if we get different opinions here, I'll do it together. But just maybe somebody could give it a try, and I'll see if you're comfortable using your calculators now.
I got 69,280 and 0.36.
69,000.
Got the same.
You sure? That looks.
I got
that looks
80,000.
80,000. But look, I mean, how could you be getting that? The total of these three cash flows, just like, well, I'm just, without discounting, right? Let's say roughly these three cash flows are 30,000 each. So that in total, it gives you 90,000. You have to subtract 60,000, right? As initial investment. So right there, it gives you 30,000 without even discounting. So how could you be getting that high numbers?
I forgot to deduct the 60.
Yeah, that's the point. So take first cash flow is -60, right? Don't forget you have to buy the machine.
I got 9,280.
Perfect. That's the right answer. Does anybody want to do it together, or you're pretty clear? Again, you just enter cash flow 1, 2, 3, 4, 16% discount rate, and that's what you get. Okay. We'll do these NPV calculations a couple more times in this class. But again, if you have questions, I can punch numbers in the calculator so that you can see them.
One question.
Mm-hmm. Yeah.
What is the cash flow for year one? If that's, wouldn't we include the 27,900 minus the original cash flow?
You have to kind of read the problem carefully. It's a good point. And we'll have kind of similar situations in every problem where we have to figure out when are these cash flows actually happening? Because you're saying, would you buy the machine and kind of have this initial cash flow at the same time? Usually not, because look, it takes time. Just simply like, even if you didn't have to like do any changes in your operation. So let's say you bought a machine and day one, it became functional, right? Because sometimes, there's a lag. Sometimes you need to build a factory or, like do something. But even if you just bought the machine and day one, it started to generate income for you, this income is generated over a year, right? So like they're not going, these cash flows, if you buy the machine and the cash flows, they're not happening at the same time. So that's why you typically have at least a year of a lag, right? Sometimes more if you need to, kind of take time to put these investments in. So that's why we have a lag.
Okay, thank you.
Yeah, no, thanks, Antonio. Good question. Anyone else?
So the only difference here is if there was a change in net working capital, and how would that work?
Yes, let's jump into that. I got this kind of introductory slide, and we can talk about the concept. So let me give you the formula, and I'm sure you've seen that. So free cash flow, the formula would be Ebit times 1 minus tax rate plus depreciation, just because depreciation is not a cash item, minus capex. And then it could be a plus or minus change in working capital. Working capital could go either way. So in this previous example, well, we had capex in year 1, or 0, I guess you could call, right? And then we had Ebit and depreciation in years 1 through 3, and we didn't have working capital. And this is this is pretty typical situation where you will have some components in certain years, but not in others. You know, this formula is kind of just pretty versatile and captures every component you need to include, but sometimes you don't have, let's say, investment. The investment happens at one point, and then at all later years, there's no investment. But let's talk about working capital a little bit. And again, we have to be careful that in the cash flows, we include change in working capital. Does anybody remember what working capital is?
Isn't it current assets minus current liabilities?
Yeah, and give me an example of current assets and current liabilities.
Inventory, AR.
That's assets and
No,
liabilities.
liabilities would be like accounts payable, unearned revenue.
Yeah. Good. Yeah, so I mean, you just take these items from the balance sheet. One thing I want to draw to your attention, because sometimes you kind of skip it. What goes into working capital is change in working capital. So let's say if you had, you know, I don't know, like $100 in inventory and then $80 in accounts payable. So your net working capital, you know, assets, current assets minus current liabilities is 20, right? But that's a given. That's at one point in time. So let's imagine the next year your inventory goes to 110 and your accounts payable still stay the same. So your working capital went up. So it was $100 initially, and then next year, let's say it went to 110 because your inventory went to 110. So your change in working capital is minus $10. And this is kind of pretty typical when you know, a business is growing, your assets, current assets would go up, but what that means is that your change in working capital is negative. So you'll see negative working capital quite often, well, negative change in working capital. And think of it as investment into working capital. You know, you have to invest in the business, in your capex, and you have to invest in working capital if your company is growing. So yeah, I wanted to kind of be aware that, you know, what goes into free cash flow calculation is that change in your balance sheet items. Does that make sense? All right. We'll kind of need these concepts for the next problem. Terminal value. I know people reached out to me about comparable multiple methodology. And for terminal value, we have two methodologies. We have multiple methodology. I call it GRIP, growth rate in perpetuity. You can just call it maybe perpetuity approach. Let's talk about multiples, and it kind of ties into where we ended last class. So we started talking about equity valuation. How do we value equity? We talked about dividend discount model. The other methodologies would be free cash flow, which is what we're doing now. But there's also kind of a shortcut methodology called the multiples, right? And you had a problem for that in your homework for Alaska Air. And people kind of ask, well, how do I even approach it? So the idea is pretty simple, you know, for these multiple methodology is that, let's just pick a multiple, let's say price to earnings multiple. And you've had that, you've had this for your homework. So, and then you were given other companies in comparable companies. So let's say if you calculate median multiple for comparable companies of, let's say 10 times, and then you apply 10 times to the earnings of the company you're valuing, and that gives you the equity value or enterprise value for the company you're valuing, right? Pretty simple approach. So the reason I talk about it here is that if you look at the kind of example like this, where you have few years, year 1 to 3, we forecast free cash flows for a limited number of years, 5 years, 3 years, sometimes 10, but we can't, but on the other hand, there's this concept that, businesses are going concerns. So there's no there's no expected end to companies' operations. So basically it's assumed to operate in perpetuity, right? So how do we capture the value of all the cash flows that it'll generate, after this initial period when we have cash flow forecast? And the second answer, you could apply a multiple, but the second answer is, well, you can also apply a perpetuity formula. And who remembers what the perpetuity formula is? We've used it many times before, right?
Cash flow over rate minus growth.
Yeah.
My cash flow divided by
Rate minus flow.
Discount rate minus growth rate, right? And again, there's always a lag. So whenever you're calculating your perpetuity value, you have to take cash flow for the next year, right? So perpetuity here in this formula, perpetuity value is at 0.0, cash flow has to be at 0.1. So that's this GRIP approach. That's the one I'll use today, but you could also use multiple approach. And then let me talk about the third concept, enterprise value versus equity value. Has anybody heard? It's in the textbook, you could read about it, but does anybody recall what the difference is?
Isn't it net debt?
It is net debt. So what do? Let's say you start with enterprise value. To get to equity value, what do you need to do? With net debt, do you add it or subtract it?
Subtracted.
Subtract it, good. So think about it. I like to give this example. Think about if you were buying a house, and house is an analogy for a business or company you're evaluating. So if you bought a house for, let's say, $1 million, to pick a round number, and you paid typical rule, like down payment 20%, 200,000, you borrowed 800,000, and your friend asks you, well, how much did you buy the house for? Like, what would you say?
Million?
Yeah, you would say $1 million, right? Like the houses are what they are. Basically the point here is that we talk about business valuation irrespective of how it's financed, right? So the fact that you've borrowed 800,000 does not kind of factor into company valuation or house valuation. So in this example that I just gave, so my enterprise value was $1 million. My net debt was 0.8 million, and my equity was 0.2, right? So kind of think about it in those terms. But also what's important for today's exercise and any cash flow valuation when you value equity, when we apply this formula for free cash flow, right? That's where we'll start. We'll take we can start with revenue, right? So we calculate free cash flow. Then what we'll do, we will discount it. We'll take the present value of the cash flows. And then all the cash flows that happen after this initial 5-year period, we will capture them with terminal value, with perpetuity formula. And then we'll also need to discount the perpetuity itself, right? Because when you apply the perpetuity formula, well, let me actually change this here. So for our purposes, when we do it today, so let's say we have 5-year forecast, we will calculate the perpetuity value in year 5, and we'll take cash flow in year 6. So we will need to include this terminal value or perpetuity value. Another term is, I don't want to confuse it, another term the textbook is uses continuity value, but basically the value of these remaining cash flows. You'll need to discount them as well. Once you've done all that, once you've taken the sum of all the discounted cash flows, you will get what's called enterprise value. And the reason why you get enterprise value is that the free cash flow is called unlevered. It's before interest, right? We start with Ebit before interest. We are not including interest in our cash flows. So in other words, the cash flows that we will be adding, they're attributable to both debt providers and equity providers, right? So our cash flows, they result in enterprise value. And then the question will be like, what is per share value? And then you go through that adjustment. You say, my cash flows gave me enterprise value. I will subtract net debt, and that'll give me the equity value. And then to calculate the share price, what do you need to do to the equity value?
Divided by the number of shares outstanding.
Exactly. Thanks, Ashley. Yep, that's all we need to do. So this is kind of introduction into this next problem, which kind of, in which we'll calculate the share price using free cash flow methodology. Okay, any questions here? So we're able to find that Excel file on Canvas. Again, what I did here, I took this problem from MyLab Finance, and just because I didn't want us to go there, because like we'll all get different inputs. So I took this Excel file from MyLab Finance, posted on Canvas. And as I mentioned, I included this very problem into your after class homework. So what I'd like you to do is follow me closely. And then I'd like to build this a solution in Excel. And if you do it with me and kind of highlight very clearly what the inputs are, you will need to change your inputs, right? It's not going to be the same answer that you just like put into MyLab Finance. You'll need to flow different inputs through this quick model. And if you've built it correctly with me now, then you just plug in the right answer in MyLab Finance. So again, follow me, and it'll save you some time later. Okay, and so at this point I'll switch into Excel, but let me read the problem here quickly. Soaring Industries has 60 million outstanding shares, and this will kind of factor into per share calculation. 127 million in debt, 55 million in cash, and net debt is basically total debt minus cash, right? So that's why we're given 2 here. And we're given the following projected free cash flows. So the free cash flow for us is calculated, right? So we don't need to create the schedule. Like in real life, 90% of your work, if not more, goes into actually creating these numbers. And discounting them is fairly simple. But here, we can't really like go into each business situation. So we are given cash flows, and then we just need to calculate the share price based on that information. So we'll have 4 parts. The first one is suppose Zora's revenue and free cash flow are expected to grow at 3% rate beyond year 4. So that kind of goes into this terminal continuity value, right? So our, I call it growth rate in perpetuity is 3%. If Zora's weighted average cost of capital is 9%, what's the value of Zora's stock based on this information? And then we'll have to kind of calculate a couple different scenarios. So in Excel, and this is just my way of doing it, you could probably do it a little bit differently. But I thought, how do I capture these different scenarios? So I wanted to show you a cool function, how you can build scenarios in Excel. I know kind of people like it, so I wanted to make this a little bit interesting and kind of show you some new formulas in Excel. But before you kind of run, well, we can, I guess, the first thing we can do is answer part A, and then we can kind of build the scenarios. What I'd like you to notice here is how I color coded this file. I think if you just download it straight from MyLab Finance, all numbers appear as black, but I like to color code inputs or assumptions in blue and formula in black. And it'll kind of become even more important kind of as we go through this problem, because we'll be replacing a lot of these hard-coded numbers with formulas. And I want to keep track where I have a formula and where I have an input, okay? So, but let's set up the base case for now. So we are given free cash flow here for 4 years. So what should we do to calculate the share price?
Do we take the present value of each of the cash flows?
We should. Again, it'll give us the present value of 4 cash flows, right? The business is supposed to function forever. So what else do we need to do?
Calculate the value of the perpetuity in year 5?
Yeah. Well, I call it, I call it the value of perpetuity in year 4, but it captures the cash flows in year 5 and after, right? But kind of let's be clear, because you have the, if you take year 5 cash flow, you get value in year 4. Okay, so let's do that. We'll call it terminal value. How do I calculate cash flow in year 5?
The value in year 4 times 1 plus the growth rate.
Yeah. And look how I will be linking all my numbers. Like I don't want to type in here like plus 3%, right? Like I've got all the assumptions laid out. It'll be important because we will be creating scenarios later. So yeah, but I just did what you told me, right? I multiplied free cash flow in year 4 by 1 plus the growth rate. So this gave me cash flow in year 5. And then what was the formula? You have to divide it by what?
Discount rate minus growth rate.
Right. So what's my discount rate?
9% minus 3.3%.
Yep, good. So that's my terminal value. It happens in year 4. So what I need to do is, well, I need to add up all the cash flows so they can discount them. I'll just call them, it's really kind of just for Excel purpose, I'll call it cash flow. So really free cash flow, but it's basically the sum of free cash flows and terminal value. So this is what this line is, and this is what I will use to discount, right? So it's cash flows in year 1 through 3, and then in year 4, it's terminal value plus the cash flow. And then just for kind of for simplicity, I'll use the NPV formula. I'll say NPV, the rate is 9% for WACC, and the values are these cash flow values just in the row above. And what did I just calculate? How would you call that? So it's sum of the discounted cash flows, but what's another term for
On the
that?
formula for MVP, please.
For what? For NPV? Yeah.
Yes, thank you.
Try following me. I'm happy to go a little bit slower, but try actually following me in real time. If you fall behind, like I'll do a lot of interesting things later, and I think it's easier if you just can you do that with me? Okay.
You just calculated the NPV right there, that 517, the sum of the discounted cash flows.
Right. What do I get? Do I get equity value or enterprise value?
Wouldn't it be the enterprise value?
It is enterprise value. Yeah? That's what I'll call it. And to get to equity value, what do I need to do? Net debt, right? I need to subtract net debt. I think you answered that before. So net debt would be negative, because I'm subtracting. It's negative debt minus cash. So debt minus cash is net debt. So minus 72. And equity value would be these two numbers added. So 445.55. Right? What's our number of shares?
60.
Yep. Again, I'll link it, like I don't want to hard code anything. I'll link it to the assumptions above, and then share price would be 445 divided by 60. So 743. Let me just quickly go back to this problem statement. So we've got 743 as the answer. Does anybody want me to go back and show you solution? Some people are probably getting something else. I'm happy to clarify.
How did you get the net debt again?
It's debt minus cash. So it's 127 minus 55.
I have a question.
Mhm.
Is the net debt negative when it's 127 minus 55?
I just put a negative sign in front of it because I'm subtracting it from
Okay.
517. I just want to kind of, I want to be explicit about that negative sign, but I just added it.
Okay.
Can you maybe review how you got your enterprise value again?
Yeah, that's the NPV formula. Any other questions, or should I move on? Try to make sure you get this one. This one is relatively simple. What I'll show you later is a little bit more complicated in Excel, but this one is just, fairly straightforward, I think. Everyone is good? Any other questions? Okay. Well, make sure you get this, right? Because it kind of, answers important. It shows that you're able to calculate the share price. The other, what I'll be doing later is just building scenarios and kind of flexing assumptions. So let's go back to this problem statement. So the point B, Zora's cost of goods sold was assumed to be 67% of sales. So in that table that we downloaded from MyLab Finance, they assumed 67%. And now they're saying, well, if the cost of goods sold is actually 70% of sales, how would the estimate of the stock value change? What do you think? If your costs went up, what would happen to the share price?
Go down.
Yeah, this one, our expectation is for it to go down. So let me read the rest, because I'll kind of handle them all at the same time. Suppose SG&A expenses change from 20%. So they assume 20%, but they will be reduced to 16% of sale. What stock price would you estimate now?
It would make increase.
Go up.
Yeah, the share price should go up. And also they say, assume no other expenses except for taxes are affected. So they kind of want us to run these two cases independently, right? So we first increase SG&A, but then we kind of go put it back to original, and then we decrease SG&A, right? So it's kind of a separate scenario. And then in the third case, Zora's net working capital needs were estimated to be 18% of sales, which is their current level in year 0. So, but again, pay attention that this working capital, it's not change in working capital. This is this kind of balance sheet amount. And then they're saying, if Zora can reduce this requirement to 12% of sales starting in year 1. So these numbers, we'll kind of flex them in all years, but for working capital, we'll keep 18% in year 0, and then we'll change year 1 through 4 to 12. And then we'll have to see what impact it has on share price. This one is a little bit tough to guess because this net working capital could kind of move either way, but we'll do that. So when I was thinking, what you could do, kind of, if you were just doing it quickly, well, you need to change these numbers, right? But I have 3 scenarios to run, and I didn't want to kind of have 3 tables. I'll show you a way to keep this one table, but have 3 scenarios. And this is fairly typical in real world. Like if somebody asks you, well, change this number, and then they ask you change that number, you don't want to just have different versions of your model. You want to flex assumptions, right? And that's what I'll show you. But before we kind of go there, we need to replicate this base case. They told us the cost of goods sold, and let me call it case 1. Let me just set it up here. So case 1 is what's currently assumed. Case 2 is this alternative case. I also have selected case, and then I'll have a switch between the 2. And the things we are asked to change, the first one is COGS, the second one is SG&A, and the third is net working capital. So who recalls, I have it on the other page, what was the base case, case 1 COGS? What did they say they assumed? I think it was 67%, right? What did they assume for SG&A? Does anybody remember?
70%. 70%.
Well, hold on. So 70, what happened here? I'm just changing formatting. Don't be kind of formats. Yeah. So 67 was case one. Yeah, case two, I think it was 70. And then SG&A, was it 20%?
Yeah, 20%. 20%.
And going down to 16, I think, right?
Yes.
Okay. And net working capital, it was 18, going down to 12. Okay. So there's this interesting function called choose. Has anybody heard of choose function in Excel?
No.
Anyone? Okay, well, you learn something new. So I'll create this switch. I'll put it on 1. So basically what 1 means, I've put in 1 for switch. 1 means I'm running case 1. But let me create this choose function. It's actually very simple. Well, let me save my work before I do that. Okay, select it. So I'll type equal, and then literally I'll type choose. And what it means is, here it says index number. So index is my switch. So my switch is 1. So what this formula does, it says it'll pick the first number I put in. So I said 1, it'll pick my first number. If my switch is 2, it'll pick my second number. And you can do, like, many scenarios. And what it'll do, it'll pick, whatever switch tells them. If it's 1, it's the first number. If it's 2, it's the second. And if it's 3, it's not going to work. So sometimes you have to do some data validation to make sure people don't, have mistakes. And then I'll copy this formula down. So all it did for now, look, it just replicated this case 1, right? Just same numbers as in case 1. But then if I press 2 here, then see it became 70%. And then, if I change the switches, they all kind of go to case 2. That's how I'll be switching assumptions.
Professor?
Yes.
What was the index number again?
Index or choose? It was choose function.
Choose the index number for choose function, the I5.
Oh, right. Yeah, it was my switch column, column I. That's where the switch is. So it basically, the what I typed in here. So the first, I open the brackets, then I put switch, case 1, and then case 2.
Okay.
Okay. Just a quick setup here. But now they told us they assumed 67% for cost of goods sold. So I'm in cost of goods sold line 15. So let's see if that's what they really assumed. So I'll multiply sales by, and now see how I will link it to my selected case. Okay, so I'm linking sales multiplied by H5. And I'll freeze H5. And it actually does give me the same numbers as in the problem. But now I will mark them black. So they are formulas now, right? And then gross profit is the total. So that should go fine. So I'm not changing any numbers. I'm just replicating what we were given, right? So that we can flow different assumptions through. And then I'll do the same for SG&A. So right now I have 93.6 negative. So I'll say sales times 20% assumption in my selected case. So I'll multiply revenue by H6, and then I'll freeze H6 and make it negative. And then I'll draw this to the right. And again, all I've done is just replicated the numbers. we have to do the same for tax because the taxes will change depending on Ebit. So right now I have 21.5 negative. So I'll say minus Ebit multiplied by my tax rate is in cell C7. I'll put that in. So far, everything seems to match with what we were given. The trick is net working capital, because what we have here is increase in net working capital. So I'll put in a couple more rows here. And what I will create is working capital. Working capital line. So remember, they said in year 0, they assumed 18%. So I'll multiply 433 by 18%. And here, I'm actually going to link it to case 1, because they said that is not going to change. What will change going forward is, the assumption year 1, 2, 3. So I'll multiply year 1. I'll multiply sales by selected case. So again, just to repeat, so in year 0 for working capital, I multiplied revenue by 18% in case 1. And in year 1, I multiplied sales by selected case. So this is in column H. And then I'll extend that. And then let's see if that's what they assumed. So they had negative 6.3 as change in working capital. So what I'll replicate, I will say equals negative. And then I'll go to 84. I have to put brackets around it. 84 in year 1 minus 77.94 in year 0. And it does give me 6.3, right? So we just kind of backed into what the number they gave us. And then if I copy that to the right, I just replicated the numbers. What I want to check now is my share price. So my share price, it changed a little bit because of rounding. It's now 744. But what it's telling me is that I just kind of see like how before I had a lot of blue numbers, now I have most black numbers. So I just created formulas instead of the hard codes we had before. Okay, so that's all I've done. I haven't changed any numbers yet, like with my scenarios. Let me pause here a little bit. I kind of went a little bit fast. So like if anyone doesn't get it, just, I'll just take, a couple of minutes here. I'll stay quiet, but ask me questions.
Can you go back to the working capital formula?
Yeah, and again, it's changes, right? So in column C, it is C13 times F7. So revenue times case 1 assumption. And in column D, it's revenue times selected case in column H. Any other questions?
Can you go back to the increases in net working capital, the negative 6.3?
So what I did here is I took negative change between year 1 and year 0 in working capital.
I have a quick question.
Mm-hmm.
So you're adding working capital there. Shouldn't our enterprise value change because of the adding working capital to the free cash flows?
Well, okay, so let me kind of step back. You know, we were given this calculation, right? And what's in here, you're right. So we are taking Ebit, and then we are subtracting tax. So right now, what they've done here, they followed this very formula. Remember this formula for working capital? Ebit plus depreciation minus capex minus change in working capital. So they just replicated that formula in row 24. So they have subtracted net working capital. So they calculate, in other words, they calculate the free cash flow the right way. You know, they're not adding it, they're subtracting change in working capital. And then again, like, you know, based on the formulas we looked at before, if you add up all the free cash flows and discount them, you should be getting your enterprise value. Does that make sense? Yeah, very good question. Yeah. Yeah, so far I haven't really changed their numbers. You know, like we were given this nice kind of calculation of free cash flow. We didn't have to do it ourselves. And I just replicated the numbers based on the assumptions that they told us they used.
Can you show again cost of goods sold, the negative 313.6, please?
So that is sales multiplied by 67% in selected case. Make sure you multiply by select case and not case 1. Like this holds true everywhere except for that year 0 for working capital.
You also show less income tax at 40%. D20 is the cell.
Yeah.
Thank you.
All right. Well, and now kind of, I've got very little to do actually, because, you know, like I have all the formulas. So now to answer this question, so how the estimate of this stock values change in question B. So basically, so let's see what happens if cost of goods sold is 70%. So I'll make the switch 2. So type in 2 for this first switch. And, you know, it should all flow through. And then you can see the answer at the bottom. It is 472. Again, if you've done everything correctly, you now have the answer to question B. So with a higher cost of goods sold, your share price would be 472. All right, so we expected it to go down, and it is 472. Any questions here? So to answer question C, we put the switch back to 1, and then we change SG&A. So we put the switch to 2 for SG&A. So it now runs lower SG&A through the model. And the share price is now 1107.
Can you go back pretty quick to the terminal value? For any reason, it's not giving me the same.
So terminal value is cash flow in year 4 times the growth rate divided by discount rate minus the growth rate.
Ah, okay, thank you.
So we get 1107 for question C. And for question D, so I turn the switch back to 1. So, and you can see the share price goes back to 744 as in the base case. And then if net working capital is 2, so if it's 12%, so there's big release. So in the first year, it changes from 18% to 12. So we get big positive impact. I'm looking at cell D23. And then, you invest in working capital as you would normally. So I get 831. So that's my answer here. Let me take just a 1-minute break. I'll be right back. If people are kind of finishing, I'll just give you a chance to do that, and I'll be back in a second. If anybody needs to take a break, just do that too. We can talk about that, but we'll give people another minute and then we'll jump back into slides. Did everyone get the same share prices? That's good. That's actually quite impressive that you followed me. And what you'll have to do is just populate these answers in MyLab Finance after the class.
I have a question. I'm assuming
Yes.
this class gets posted right away after class on the software that we use to rewatch the classes.
Yeah. It takes me a little bit of time. It's a big video file. It takes me a little bit of time to download it, but I'll post it today. Yeah.
Awesome. Great.
Yeah,
Thank
it'll
you.
be on Canvas. Do you usually watch it? Like, is it useful to see the replay?
Well, I think I have to rewatch this because there's a few that I'm missing. So.
Okay.
Yeah, thanks.
Yeah. Well, the good thing is it's working for many people, so
yeah,
it should be fairly straightforward. So these are the answers if you want to kind of take note of them. Because again, like you'll have different answers in your problems, but if if you can replicate them.
Okay, thank you.
It's pretty simple. Any other questions on this Excel problem? We're good. Well, let's move on. I think most people are back. So the rest of the class today, I'll kind of be in typical format. I will, solve problems here in PowerPoint together. So Beats wants to build a new factory to produce its headphones. It will cost 170 million initially to build a factory over the course of 12 months, which will be worthless after 10 years. The factory will be depreciated linearly to 0 over 10 years. Beats already owns the land on which the factory will be built. The factory is currently worth 10 million. Sorry, the land, not the factory. The land is currently worth 10 million, and the land was purchased for 2 million 8 years ago. How do you think we should handle this land value? Like, do we include it in the CapEx? And if we do, at what value?
No, you don't include the land.
I think I've heard you don't, but then like, what was the discussion around that?
You don't because it's a sunk cost.
Yeah, but you could also sell the land. Like if it's currently, they're telling us it's currently worth 10 million. You can't just take it for free, because you could have sold it, right, and put 10 million in the bank. I agree. 2 million. The fact that you bought it for 2 million in the past, that is sunk cost, and that is not relevant. But do we just get to use it for free, like if it's valuable? I think you have to account for that. Just and think of it as an opportunity cost. So let's just keep reading. After completion of the factory at the end of year 1. So I keep kind of note of the timing here. Let me maybe draw it here. So they're telling us this is, this is 0, 1, 2, 3. And then kind of goes to 9, 10, 11. So this is in year 0 is when the investment happens. So minus 170. And I would actually include minus 10 here. The value of the land, that's year 0. And then the factory is built after the completion of the factory at the end of year 1. So so there's that gap. And then Beats expects the earnings before interest and taxes to be 32 million each year. The company must also add inventory components worth 7 million just before the operation starts at the end of the first year. So there's actually, they need to invest and then they actually build. So like in this timeline, what we will assume is that the inventory gets purchased at the beginning of first year. So there's kind of 1 year gap there. Then the cash flows start at the end of first year, which in our timeline is year 2. So, and I'll call it Ebit. I'll just put it here. Ebit is 32. So that's when Ebit is happening. It's not cash flow. We'll have to calculate the cash flow, but the you know, the cash flows start in our timeline in year 2. And then the cash flows will happen for 10 years. So they'll actually go until year 11 here. And then in year 11, we'll have what's called release of working capital. So we'll have positive 7 for working capital. And then we'll get the last 32 Ebit. So that's kind of the rough timeline. What I haven't done yet, I haven't calculated the free cash flow. We'll have to do that together, but this is kind of how this problem looks on a timeline.
What were to happen if the question said it will cost 170 million initially to build a factory over 3 years?
It's a good question. You know, for your purposes, like you have to put a point in time, right? And that's why I think, you know, you'll usually, you know, the problem will explain, like, I mean, assume something, you know, like, I don't know, maybe it happens like in three sums over 3 years. So it's got like 1, 2, 3, right? But you kind of have to make that assumption. And in real life, I mean, basically the way you address it is, you know, like if you have periods, you kind of allocate certain investments because they happen probably over, you know, like in different tranches. And that's what you do. But I would probably, if it says over 3 years, I'd probably divide it by 3 and put it in 3 equal amounts, unless you're told otherwise. But again, you know, the problem should be clear about that. Well, let's look at the questions here. What's the capital expenditure in year 0? So what was it on the timeline? Who remembers? I think we answered that.
170.
Well, 170 plus the value of the land. I think that's what we decided on, right? Because I just don't feel comfortable using the land for free, right? Like there's value to it, so you have to add this value. And then what was the free cash flow in year 0? So it's kind of, I guess, tricky question because you know, if you look at this formula, you remember, like I told you, like you can use it in different situations. So there's basically no EBIT, there's no depreciation. So the only thing that's happening in year 0 is CapEx, right? No change in working capital. So the free cash flow in year 0 is actually minus 180. And then free cash flow in year 1, that's when we put in money into working capital, minus 7. Yeah, go ahead.
You take taxes into account for free cash?
You will, yeah. But we haven't, you know, you pay taxes on income. So far we haven't had any income. So let's calculate what those taxes would be. So what's the annual depreciation year 2? How much did you buy the machine for? 170, right? It was 170 depreciated over 10 years. So that is 17. We'll get to taxes in a second here. So free cash flow in year 11, actually like any of the 10 years. So the free cash flow would be, let's see, what do we have here? Ebit, we were given Ebit, 32 million. And that thing we tax impact, we say 1 minus 21% tax rate. So Ebit times 1 minus tax rate. And then in our formula, we add back depreciation, right? So again, we had to account for depreciation just for tax reasons, but now we'll add it back. We add back 17. And then the CapEx is all spent. So there's no CapEx, there's no change in working capital. except that in the last year. So let me call it year 1 through 10. So what is that? Let me calculate that. Gives me 42.28. And then in year 11, kind of what you were asked here, it is 42.28 plus release of working capital. So if I go back here, maybe that'll be easier. I'll replace Ebit with cash flows, right? That's really what we care about, cash flows. So my cash flow is 42.28. Right, in all these years. And then here it's 42.28 plus 7. Can somebody give it a try and see what the NPV is? If you get a different number than I do, then we'll do it together, but let's see if you can, like what answers you get for NPV.
$47.51 million.
I get a little bit different number. Anybody else want to try? It's close, but not exactly. Did somebody else get a different number?
65.86.
No, that's too high. That's a little too high. Well, let's try it. I mean, does anybody else want to suggest some other numbers, and then we'll do it together, but maybe one more try. Just tell me, anyway, if you've done the calculation, what do you get?
What's the discount rate again?
10%.
$49.81.
No, let's try it together. I don't know what I just did here. I was trying to change my, okay. So I changed my, I see like I had a comma here. I just downloaded this Chrome extension. And I was trying to customize it, but I pressed something where I have these zeros now. Okay, I think hopefully they don't create an issue. So let's do the cash flow 0 was 180 negative G, I'll press it as cash flow Oh, I don't know what's happening here. And if I close it, would that be any different? No, it saved it. I just pressed F point. Okay, I think I'm back to normal here. Just kind of had to readjust my settings. Okay, so let me do it kind of carefully because sometimes, yeah, you can mistype some numbers. So 180 change sign is JCF0. And then -7 is my next cash flow. And then 42.28. I'll press G, CFJ again. And then I can press 9 for 9 number of periods because it's happening for 9 times. So I'm pressing G, and then where FV, future value, is just below that, there's NJ. So this is 9 periods when my same cash flow is happening. And my last cash flow would be 42.28 plus 7. So 49.28, and that's J, and then I'll press CFJ again. 10 is the discount rate. And then I'll press F and PV. So I get 52.26. Does anybody else get the same number? I've heard different answers. I don't know why, but I think this one is correct. $52.26. Questions here? Comments? Let me go to the next one. So this is about kind of capital gains. Capital gain is the difference between the value that you sell the asset for and the book value. And really, the reason it matters is that if you sell an asset and it's depreciated value, book value is less than the sale price, you get capital gain and you pay tax on that. And what we'll assume here is that if we sell for less than the book value, we have capital loss, but we also would assume that we can use that capital loss in other parts of the business. Basically, like if you're a large company, you buy and sell assets, so we have losses, we can offset gains by those losses. So basically, we'll assume that we get credit if we sell at a loss. So that's kind of what this problem is about. So time winner is now at the end of the final year of a project. The firm originally bought some project equipment for $80,000, which now could be sold for $48,000. 51% of equipment cost has already been depreciated. The company's tax rate is 34%. What's the after-tax cash flow from asset sale? It's not so much about free cash flow, it's more about kind of capital gains, tax or loss. So what is the book value of this asset? if it's 51% depreciated.
Is it 80,000 times 49%?
Good. So that is 39,200. So that's the book value. So capital gains, well, let me do it in one shot. So the tax would be capital gain times the tax rate. So it'll be sale price, 48,000 minus book value, 39,200 multiplied by 0.34. And that is 2,992. So the after-tax cash flow is 48. Let me put it here, 48,000. Then minus this tax. So that should be 45,008. So that is the after-tax cash flow. Does that make sense?
How did you get the 49% from the book value?
Well, the problem says it's 51% depreciated. So we've taken 51% as depreciation and 49% is left.
Oh, gotcha. Thanks.
Can someone try the second part? It's kind of very similar, just with a different after tax, well, with a different sale price. Book value isn't going to change. So the only thing that will change is this 48 here becomes 35. So what would be the proceeds?
36,428.
Perfect. I like that. Does anybody kind of get a different number and need some clarification? But this is the right answer. Let me move on. We kind of have a couple of small problems, but we don't have much time left, so go through it quickly. Southwest Airlines, so this problem is about the modified accelerated cost recovery system. Basically what it does, this table here, it's kind of dictated by IRS. So these depreciation rates are given to us. So we've got 7-year property. So we are in this bucket here in the middle column. So Southwest Airlines bought a new jet for 34 million. It falls into 7-year category. The jet can be sold for 27 million after 5 years. And the question is again, like, what would be the after-tax cash proceeds if they sold it? So it's similar to the previous problem. What we need to do is to calculate what's the book value after 5 years. So, these numbers here, these percentages, they add up to 100. So what happens basically is instead of kind of, let's say for 7 years, instead of taking 1/7 every year, we're taking off different percentages, and early on we take off more as depreciation, so we save on taxes. So that's really why we use this system. But to calculate the book value, we just need to see, what the total of these percentages is. So it's 892 plus 893 plus 446. So I get 22.31%, and then multiply the original value. So the book value would be 34 million times 0.2231, and get 7.5. This is 7.5854. That's my book value. So there's significant capital gain, right? So let me say tax right there. So tax would be 27.2 minus 7. The book value I just calculated, 75854 times 0.34. So the tax is 6.66896, and then you subtract that number from the proceeds. So cash flow would be 27.2 minus 6.66896, and that is 20.53 roughly. Does that make sense? All right. The next one is very similar. We'll kind of fly through it quickly. Company bought a machine for $69,000 3 years ago. It falls into the 7-year depreciation category and can be sold today for $40,800. A replacement machine could be bought and installed for 102. What's the current book value of the original machine? So they bought it 3 years ago. So they have year 4, 5, 6, 7, 8 here. It's kind of all these numbers below. So I get the total of those to be 43.73. Again, it's the sum of these numbers. 43.73%. So the book value would be the original price, 68,000 times 0.4373, and that is 29.73. That's book value. So the tax would be 40,800 sale price minus book value. Sorry, 27. Let me just add some decimals here. So 29,736.4 thousand So 29,736.4 times 34%. So that gives me 3,761.62. What is the after-tax cash flow from the asset sale? So they'll sell the machine for 40,800. They'll pay tax of 3761, and then I'll get net proceeds of 37,038. And then the initial investment would be, so this is to replace a machine. So they have to buy a new machine for 102, and then they'll get back. So this is kind of, think of it as negative, and then they'll get back 37,038. So the initial investment to replace would be minus 64,961. Or 962, I guess. It's kind of a little bit dry, I guess, but any questions here?
Why do we take the tax rates from year 4 and on and accumulate those?
Well, it's not tax rate; these are depreciation rates, right? You're talking about this table here on the right-hand side.
Yeah. Why do we?
Yeah. So this is to calculate the book value. You see, I'm taking book value, multiplying it by 43%, and this is this Macker's depreciation schedule. It's used for tax purposes. You know, for business purposes, we kind of usually use straight line depreciation, right? But here, see how these percentages are higher earlier, right? 24, 17% early on, and then they go down. So this is basically a tax incentive for investments, right? They allow you to depreciate more earlier, and that goes as a deduction against your income, and you pay less taxes. But to answer your question, we have to calculate book value, and using these depreciation rates, you know, that's the book value that we get.
Professor Baker, will your depreciation expenses, they will stay consistent across that MACRS depreciation timeline, correct? You're just applying it to the change in rates, essentially year over year.
Well, you're applying these rates to the initial cost, to 68,000. So there, you know, I don't know if I'm confusing you, but you know, if you apply these rates just mechanically, your depreciation will be high initially, and it will go down later in life of this machine. But these are tax depreciation rates. There's also, I think, what you may be thinking about, kind of business, or you know, like kind of, we call them GAAP, generally accepted principles tax rates. So they can be different, right? So what you could do, you could depreciate it what you think is the right depreciation rate is, like economically, and let's say it's straight line, and that could be different than your tax depreciation. What I'm saying is, you know, the depreciation for accounting rules and tax rules can be different. And what you said, like, would it be consistent? It can be consistent for accounting purposes, but it would be high initially and then low later for tax purposes.
Okay, thank you.
All right, well, I've got my last problem. I don't have much time. You guys have energy for one more? We've got 5 minutes left, and it's, yeah? You got some nods there? Okay, well, if I keep you a couple of minutes later, don't blame me. All right, so this is build versus buy decision. So the idea here is that the company, bicycle manufacturer, produces 336 units. And they purchase, chains for these bicycles for $190. So they're thinking about an investment that would allow them to build these chains in-house for $1.60. But to do it cheaper and to do it in-house, they have to invest. They have to invest 2,000 or 3,000 into a machine that will last 10 years. It'll become obsolete after that. So the investment could be depreciated to zero for tax purposes using 10-line straight line depreciation schedule. They will require 42 million in inventory, which is working capital, and it'll be released after the project. And well, so they'll depreciate the machine, but they can still sell it. So there will be a bit of a proceeds on sale with a little bit of capital gain. So they want to understand present value of each decision, present value whether you keep buying, so basically present value of buy, or present value of build. So if you build in-house, compare the two and make a recommendation. Should you do this project or not? So let's call it buy NPV. Buy is, again, it's kind of status quo. It's what they're doing now. So they're buying these chains. So free cash flow will be, and let me write this formula, which will kind of make it easier. So free cash flow. So I'll spell out Ebit a little bit. So Ebit is really a revenue minus costs minus depreciation. So that's Ebit. And then we've got 1 minus tax rate. And then we'll add depreciation minus CapEx minus change in working capital. Just kind of want to have it here for reference. So what we are given in this problem, we are not given revenue, but we are given cost, right? It's 190 to buy per chain times 336 chains that they need to buy. And because it's our cost, it's negative. And we'll kind of just substitute it in this formula. So we still need to multiply this by 1 minus tax rate, and their tax rate is 20%. And that's all. So like if they keep buying, that's how much they'll be spending after tax per year. So that calculation is minus 510, 720 in free cash flow. So this, again, there's no revenue, it's all cost. So like if they keep buying, this is how much per year they'll spend after tax. If they build, then there's it gets a little bit more complicated. So there's year 0, and then there's year 1 through 9, and then there is last year. So in year 0, there's investment in CapEx. There's minus 203,000 minus 42,000, which is minus 245. And then free cash flow in year 1 through 9, there's no CapEx, no working capital, but it'll be kind of similar to what we calculated for buy. So it'll be 160 negative. So they'll they'll make these chains for 160. The volume is the same, 336,000, and the tax rate is the same. So the cash flow will be a little bit less, right? They can do it cheaper in-house. So that'll be 426.20. And then last year, it's the same as in the year 9, but you get the release of working capital. So it'll be minus 426.20 plus 42,000 release of working capital. So you get minus 371, 840. And then what we need to do to compare them, so let's say NPV of buy is, let's plug these numbers in. So it was 510, 720 negative. I'll make it a payment. I'll say 10 times is number of years. And then the interest rate is 15. So the present value is 200,563. So it's 2,563,186. And it actually should be negative. You know, the calculator reversed the sign, but you know, kind of because the cash flows are negative, NPV will be negative. NPV of build. So if I run similar calculation, you know, the answer is minus 2,369,703, also negative, but it's a smaller negative number. So NPV of a project, so NPV of kind of decision to build would be the difference, and it would be a positive number. So our recommendation should be to build this machine, and the difference between the NPVs would be 193.482.